It kind of seems like I am just throwing things at the wall to see if they'll stick, like thinking about every weird person that I know, all the gossip that I've ever heard. That is exactly what I'm doing. I don't know what else to do. If you're not familiar with my story, my name is Megan Mason. In 2016, I became involved in an awful divorce, trying to leave a controlling, abusive man. And I found out that divorce case is an even worse place for abuse. And then 2021, I thought that I was so lucky because I discovered that the Chicago divorce court that I thought was just, kind of mildly crooked, shady, strong arming by tough city lawyers was actually over systematic, highly organized, and destructive corruption, like good old fashioned mob crimes, fixing cases, committing fraud, taking bribes. And I tried everything to get it to stop. And I tried to get federal prosecutors to become involved. And in this spring and summer of 2021, I couldn't get anyone to return a phone call from Merrick Garland's DOJ. I just thought they were busy. And so then I was frustrated because my boys were complaining about their father now abusing them. And I wanted to do anything to get them away from him. So I went to the people I knew how to talk to, the IRS, because I was trained in anti-money laundering. I'm really good at accounting, and I was a vice president at a bank. And the head counsel for my bank also knew that what I gave them was enough to send my ex-husband to prison. So I didn't have to worry about my divorce case because he was going to be deported and my kids were going to be safe, and I didn't have to worry about Chicago corruption. But instead, I was issued whistleblower numbers, and every aspect of my life has been turned upside down. After the judges I testified about in my whistleblower report found out about it, they took my children. They've taken my ability to even earn or retain money, taken any money I've ever earned. And I'm genuinely struggling to support myself while people think that I'm crazy, while I don't have any mental illness I can get treated for if I wanted to. I'm the victim of corruption, and people with large strokes understand, oh, fascism is happening. Institutions have broken down to enable fascism. But when I'm explaining exactly how the destruction of the American legal system, not just a few people at the Supreme Court that our team talks about, but the courts across the country, that the probate courts that can take the money away from you, like they did to Brittany. You think that when MAGA decides that they don't want Black people owning property, they aren't going to use probate courts to decide that maybe Beyonce shouldn't be trusted with that money, you know? But no, that's crazy to you. No, and it won't happen to Beyonce because she'll be behind the wall of billionaires. But um, the rest of you, good luck. Good luck, assuming that I'm lying. But the people that have always believed me are still a presence in my life. For some reason, federal prosecutors or federal investigators, because they're in every state I go, everywhere I go, every aspect of my life. They're building a bigger case, but I don't know what it is. I assumed it was the Senate for a while. That's what I recently thought. I still think it is. I think Dick Durbin and the Senate Judiciary Committee have done a lot to hide corruption in Chicago. And I think that they were also hiding other forms of corruption. I think if you look back at the Senate Judiciary Committee, you're going to see that anyone with any backbone who wasn't compromised was kept off the Senate Judiciary Committee or removed. They made sure no good guys were on the Senate Judiciary Committee because the Senate Judiciary Committee knew what Epstein was doing, knew what all these people were doing. But you can believe that they didn't. That's the party line right now, right? The Democrats are the good guys. Great. See how that works out. But then I'm like, shaking out my handbag to see what other rotten things I can find. And I have this ex-boyfriend. And I thought of him because, and that's what made me think maybe my case does tie to Epstein, because he was a trader in the 90s, the 80s and the 90s, when options trading was developed in Chicago. He was there when the markets were being formed. He made markets in a very famous stock, limited stock. And that meant that he could do large trades, large institutional trades, and he would always have enough of limited stock to cover those trades. He had some connection he had told me that a connection paid for his seat on the board of options, which I've seen, Gemini gives you different numbers. Sometimes they say the 90s started with a seat costing $75,000. Sometimes they say it went to $200,000. I just know at the end of the 90s, it was up to $2 million. So, because you could make a lot of money as an options trader, doing legitimate business, of course. So I thought about that because Les Wexner's stock could be a way that money was laundered, maybe from other sources. And then I just was thinking about the timing of Mossad operative and British financier and Ghislaine Maxwell's father, Robert Maxwell. Robert Maxwell, it's no secret, it's no conspiracy theory, worked for Israeli intelligence. That was his job before anything else. And when you work for your country's intelligence, that's always your job. Like, this isn't like some conspiracy theory about how intelligence services work. So he was working for the Mossad when he stole $500 million from British pensions. And supposedly nobody knows where that money went. I think the CIA probably did know where it went, because I think that our government decided at that time and maybe made a Faustian bargain. Mossad seemed to only be going after progressives, maybe. They weren't going to bother Republicans or the kinds of Democrats they needed to work with, maybe. That is a conspiracy theory. I maintain it, but it is a conspiracy theory. But we know that the people that Robert Maxwell worked for, Mossad, were working to undermine our institutions. I don't know about you. Maybe you're more sophisticated. I've been busy with things. I swallowed the party line that I didn't like Israel or America's foreign policy. I protested every American war that I can think of. In the 90s, when I was becoming aware of politics through, the last 30 years, I think like a lot of Democratic Party voters, foreign policy wasn't my top issue. But the other thing is that I just swallowed the party line that all these people telling me Israel was our ally were telling the truth. But since they were not behaving as our ally, that was not true. And maybe those people thought they were our ally, but their intelligence agencies are working for their government's interest. So they're happy to break our financial institutions. They're happy to break our citizens. They're happy to break our civil rights. They're happy to sow division in our culture, to increase racism, to even increase anti-Semitism, to support their country's fascist, military, genocidal goals. And they're doing a great job. I would say Mossad has more rights in the United States of America than Megan Elizabeth Mason at this time. And if you're going to call it a conspiracy theory, I have a lot of receipts, and you better be able to read big words. But I know there are some people who want the truth to get out, who've been looking into something, because people want me alive to testify about something. And so I was thinking more and more about my ex-boyfriend and his making markets and limited stock. And I was also thinking about the nature of options markets. And another thing that he told me was that he was under investigation for fixing horse races. And one thing about fixing horse races for the mob is it's incredibly hard to pick a winner. Like, that's what all the schmucks gambling are doing, right? They think they have a winner. It's much easier to pick a loser to throw a race. And I'm just wondering about markets. It's pretty hard to fake real economic growth, although you can definitely juice things. But when it's artificial, it's going to come down. So really any juicing is going to drive it down, right? So if you're a gambler who's betting on losses, it would seem it would be easier to effectuate those losses. And this ex-boyfriend was a bearish trader too. So then I was thinking about the options market as a potential place for front running markets. And I'm not a genius. There are lawsuits about this. But as I was like looking at this and trying to like think, and what I mean by front running. So front running is when you're trying to make money by tricking the everyday institutional investor. Dumb money is what sometimes that's called. You're trying to trick them to pour all of their money into a trade where you're going to get out with your winnings before they realize they've been tricked. The traders, like, well, I wasn't a trader, I was a financial advisor. But traders and financial advisors, when we're buying and selling stock, that's pretty tightly regulated and monitored and recorded. Even in the 90s, I think it would have been real-time trading for equities. And but options are a little bit different, especially in the 90s. So I think they were written by hand and settled by hand. But what's more interesting is when you think about an options market. So for one thing, an options market relative to the actual underlying holdings is much smaller. Another thing, to spend money to move an options market, you spend much less money because you're buying essentially little insurance policies. So those insurance policies, because most insurance policies don't get cashed in, or most insurance policies, if they're not in the money, aren't worth cashing in, then you're spending very little money to make impact, potentially. But that's where it got kind of funny, because I was like looking at, okay, if it's kind of hard during that time. You can get databases, but not during those early years. I think probably out of business school you could through a database, but I couldn't without paying for a subscription, and I'm a hobo. So I was just looking at what I could find on Yahoo Finance. And then I was thinking, well, as you look at counting options, of course, you think of the VIX. And I'm very familiar with the VIX. We still use it. But the VIX is an interesting index because it's called the fear index, the kind of fear that predates a bearish market. But the fear and the basis of the VIX is that you look at options, puts, and calls. So a put is the right to sell a stock, and a call is the right to buy a stock at a certain price. And so you look at puts and calls on the S&P, at that time 100 index. The theory is that as people are buying more options to cover their positions, there's more panic. So that's why it's called the fear index. And it's one of those things where it's very good for marketing to retail investors because, it's like, this is what the real investors are doing. This is like the options market, what the professional traders are doing. So the VIX is like letting you know before, the everyday schmoes who aren't like sophisticated like you, they know what the market's going to do. As far as I know, it's still pretty standardized, especially when you're trying to sell variable annuities. But that was another interesting thing about the VIX. I mean, it's like, it sounds too much like a conspiracy. So the concept of this kind of index was invented by two Israeli academics temporarily studying in the University of Chicago, and they were sitting in the pits in the early 90s and 80s with Chicago options traders when there were very few options being traded. Options were kind of a new thing. And so these academics came up with this idea for the VIX. And obviously other academics think it's great, and it became adopted, which I thought, it is kind of funny that I was looking for Mossad money, and then there's two Israeli academics. I mean, people obviously go to graduate school all over the world. And I will say that when the CBOE, the Chicago Board of Options Exchange, when they developed the VIX, like a year after these academics, it was accredited to a different academic. And one of the Israeli academics has loudly complained that he doesn't get credit for it. So I do feel like if it's an Israeli conspiracy, he shouldn't be out there trying to get credit. But I mean, finance people have big egos, so maybe it's like he'd rather get credit than be a cool market manipulator. I don't know. I mean, it's just a coincidence too. I don't know that any manipulation happened. I just thought it was funny that they happened to be Israeli. So then I was reading up more on the VIX, and this is kind of what's interesting. Um, so, like I said, there have been lawsuits because people have alleged that options traders have front-run markets by like creating false kind of run-ups in options markets to create movement in a stock and then screw the investors. But then I found another interesting article that kind of looks at it on more of an academic level. And this was written by the VIX, CIV, and MFIV, measuring up the accuracy of option-based predictors of volatility. And it's from Kellogg, which is Northwestern's business school, and it's by Torben Anderson and Oleg Bondarenko. But basically, they were looking at the VIX, and they compared it to different other supposed predictors of market volatility. So they're looking at the VIX in terms of kind of the market proposition that financial advisors like I am taught to sell these products related to the VIX. And basically the premise is that the VIX can predict market volatility. And their findings, when they looked at the volatility predicted by the VIX and what actually happened in the market, was that indeed the VIX correlates to market volatility. So that's a correct intuition that it's going to move. But the challenge was that it over predicted by 23%. If you're an insurance product salesperson, you're probably saying, oh, well, what's the harm in that? Everyone wants to keep their loved ones safe. Who wouldn't want extra protection? It takes a certain cognitive ability combined with ethical weakness to really be a successful insurance salesperson. I think, the best ones actually believe what they're saying. But most people would point out that if you're selling a product based on a risk that's not there, that 23% that people paid for variable annuities and other forms of risk protection or just straight up options premiums, you could argue that 23% could be placed somewhere else. Obviously, it doesn't work like that. You can't quantify that in a dollar amount exactly. But I do think it's fair to say that overvaluing risk could be manipulating investors in a very harmful way. So it's just interesting to me that at the time that these funds go missing, if you look at what happened between like 1985 and 2000, there begins in 1991. And I looked at 1985 because that's about 1985, 1986, about when he had started siphoning money. So you can presume that some of the money, I would guess that they probably hid it as investments. I think a lot of the money was investments. I think a lot of it may have gone in the form of angel investments or loans on the hard money markets. I think that some of that money could have gone to seats on the Chicago Board of Options Exchange. I think some of that money could have gone towards options. Some of that money could have gone towards equities. If we're looking at the potential for an influx of capital to kind of change markets, I just think it's interesting to look at the options market as a fulcrum, because when you look at the actors in the market, relative to, I had very little experience, but it's an important experience, I think, for showing how the market can be manipulated. It's a very small number of people, supposedly speaking for other hidden powerful institutions, influencing much larger markets. And there's a lot of trust based on those advisors and options traders, which is funny because in terms of, what's the movie that the Gen Z guy, the one with the guy who sleeps with 20-year-olds, anyway, it's supposed to be a cautionary tale, but it's just like excesses of like dirty trading. They think that's hashtag goals. Yeah, like from what been told, I've known a few options traders from the 90s or who worked in the 90s. And at that time, and I've heard this from other girls who worked in different industries, that when, for example, limited stock was trading heavily and the options markets were being created, traders traditionally were drug dealers and financial advisors were pimps. I don't know why that started, but financial advisors usually brought women and traders usually brought drugs. Because there was a lot of money and the firms weren't tracking what the advisors were spending it on. So I think they could use corporate cards for escort services probably. But I just wanted to talk to you about dirty old men. That is separate. Well, not totally separate because it's about extra cash floating around. At the same time, there were also famous basketball players in Chicago, very famous, very rich, who loved to play poker. And those games were expensive games and they weren't necessarily run by Boy Scouts. And that's another way that money gets worked into the economy. And so this boyfriend of mine was at those games and, where they try to bring in the dumb money celebrities to get the money laundered in. He was involved in those horse races that went the right way. And he was involved in the board of options when these new volatility indexes and methodologies were being invented. And of course, the derivatives that in 2008 crashed our market are also closely related to these options markets. Interesting coincidence. But I'm going to just explain options from my perspective because I think it's like the simplest. I was never a hedge fund trader or anything like that. This is, you would call a very vanilla option strategy. So I had a client who was an executive, but not the CEO. And this matters because of the amount of stock that somebody holds and how restricted. But he had a large position in restricted stocks. So I met him before the IPO, which is when you want to meet them. And we were talking about this big influx of cash. And I prepared him because here's the psychological challenge. If you have a brokerage account and there's, and it's 90% stock in Chevron, and you keep that Chevron stock, and then tomorrow you still have Chevron stock, you have invested in Chevron. You're spending money on Chevron. So you don't think of it that way. You think, oh, I just happen to have it. I didn't buy it. I didn't choose it. And I'm certainly not choosing it, especially let's say it's down or you don't want to own oil stocks. That's where the psychology gets really challenging with restricted stock. Because we talked about it, I said, this is really hard because you've worked in this company and you have this idea of the value that the stock should be. And you're going to have to sit there while it's traded and not be able to sell it. And that's going to be hard. But you need to commit right now to selling off the majority when it frees up. Because we agree that for your family, it wouldn't make sense for you to take 90% of your investable assets and put it in a risky new tech stock. You wouldn't do that. So we're not going to keep it there. You're not going to keep it there because obviously it wasn't under my discretion yet. So we agreed that we would keep 15. He was earning a lot of money. His wife she had earned money. She was having medical issues, but they were very well off and earning more money. But this was their biggest asset. And so we agreed that he was going to sell all but 15% of his holding, no matter what the price was. And of course, I think it was like 70 at its highest and then 40. And then when it cleared up to trade, it was like 20. But of course he knew better. He's like, oh, I think it's going to go up. So I'm going to hold on. It didn't go up. So he's holding on to this massive exposure. And that's where options actually are a good strategy. So first I just talked to him about the possibility of writing covered calls. And that just means that it's almost like you're loaning your stock to somebody. So, and it's a sales strategy that they taught me at Morgan Stanley that works really well. Like the example was we were working in the northern suburbs. So it might be like a Walgreens executive maybe a salesman who worked really hard and like really believes in the company, loves the company, and they won't sell their stock. So you say, okay, Larry, you know so much about Walgreens and all the potential that it has. Why don't you tell me what the price would be that Walgreens would be worth? And then he tells you, and that is your strike price. So then you could buy covered calls and you say, so Larry, if it gets to that price, you know, they're going to exercise their options probably, because it's what that means is, so if Walgreens stock is $30 and you say you write calls for $32, that means if it gets past $32, the person who bought the option is going to sell it, buy it so that they can make the difference. And they aren't going to exercise it if it's below. So Larry's going to keep his stock and just get that money. And that is something that was a low rate environment. So that's like a strategy for when there's not a lot of interest options too, which isn't a problem today. And then because you have the concentrated position, if you're lucky, then you can get enough of an option, a premium from the calls to make a straddle. So you buy your own insurance. So that way you're holding on to all of the stock. So instead of going up to $32, the Walgreens stock goes down to $15. You're panicking. You've bought the right to sell it at $28. So you can just exercise that and know that you don't have to worry about it going to $12 or whatever. I'm a very conservative position. But when I was filling that position for my client, I was totally blind, even within my bank. So we had a trading desk in New York. That trader did not have any insight to my client list. For all that trader knew, I was representing the entire board of that company. I might have had lots of shares available somewhere, or I might not. I might have a lot of people interested in options, or I might not. That options trader does not have a way of knowing. I don't know if in the 90s there was any way to know if people bidding on options existed, whether my client existed when I, as an advisor, bid up options. I don't know how they would know if that client exists. Because if I'm saying to this options trader doing this one position for a mid-level executive, what if I also say, wow, you know, that you did a really good job on that. You know, I've got a lot of these guys between you and me. I'm sitting on a lot of positions and they're getting really nervous, you know. I mean, you can't do insider trading, but there are a lot of things that you can say. There are a lot of things that you can say, including that you have people interested in a price. And when you have people getting a lot of quotes, I feel like that can impact the price, because that makes people think the quantity of available shares to cover trades might have more value. There are a lot of ways that the advisor could manipulate the market. And then I think there are also a lot of ways that the options trader could manipulate the supposed level of interest in options. But, and I mean, to be frank, the way that market actors, so that's brokers, traders, bank executives, the way they always look at every system, you know, whether it's a currency, a market, a business, this is kind of what late capitalism is built on assuming, is that they're going to try their hardest to break it and cheat. That sort of, you know, FINRA did create a somewhat successful self-regulation of cheaters, because people catch the other people cheating because they don't want people able to cheat in a way that they weren't able to cheat. So it's like, if I can't pull off that cheat and I see you cheating, nobody's going to get it. And it actually does kind of work a lot of times, unless you have a whole market of options traders and advisors who can all get paid well fucking America. Because that's what's interesting too. You know, what the reason that the seats are getting driven up in price on the board of options is the industry just skyrocketed with the involvement, with the creation of the VIX. Suddenly, insurance managers started becoming more involved in buying delta in the options market. Before that, TIAA Craft invented the variable annuity, and it allowed their participants to get a little upside from the stock market, but if the stock market went down, they didn't get anything. So it was basically, an annuity was pooling the resources like any insurance product. And as people die, they get paid out. As people join in, they pay in, and hopefully they keep it up. And then, of course, now they have managers to handle that. But there were no options traders when it was invented. And then through the 90s, shortly after the VIX, then suddenly insurance companies start investing in options. And I did encounter that too. I had a wealth management prospect who basically had a variable annuity company. He had been an options trader, but he was younger, not a market insider. I guess I'm saying he didn't seem as shady, but he basically sold his products to European insurance companies. They are at that time, because of the low rate environment, especially, there was a lot of interest in variable annuities with market protections. And I had developed models for ESG investing, like a model of companies that support people of color, and then a model of companies that support working families, screening like for whether they participate in the CEO action for diversity and inclusion, or other things that I could make into a matrix to screen the stocks. But because this wasn't like a standardized index, there aren't options written on it. So we had to figure out potentially what market to index my models against so that he would be able to buy the downside options, if that makes sense, without having to go through and buy individual options for each stock in the index. So, but that industry didn't exist. And if you look at, and that's where it's like, when I think of this influx of capital and its potential to act as a fulcrum on our markets. So the early 90s, when Maxwell's money goes missing, is also when all the angel investment was happening that led to the pre-IPO tech boom. That's a time when somebody like Mark Cuban might have been given a loan that he later came to regret. I raised Mark Cuban because I just described to you what my ex-boyfriend did, the kind of character he is. And we know that Mark Cuban makes a big deal out of being a good guy. He's a girl dad. He does the right thing. Yet inexplicably, he is kind of endorsing Donald Trump. He wouldn't say that. I was fiercely critical, but Mark Cuban would say he's critical of Trump, but he went to the White House to talk about government programs with Hitler. He knows what he is. He knows what he's signing on for. And only he knows why he's doing it. So in terms of other weird things, I think it's really weird that Mark Cuban, who really likes to depict himself as an ethical, not a liberal, but your good kind of conservative guy, like you're Mitt Romney, not gonna lynch a guy, we're just cool. And despite that, he's endorsing somebody who's heading a Christian nationalist movement that might not let his daughters vote. And he's a billionaire. He's a powerful, big man. And he's endorsing a threat to his own fucking children. So if Mark Cuban isn't compromised, he is a disgusting excuse for a man. But I think he's compromised. And I think it happened when money was being invested in his early companies, when it was private markets that are not transparent and much harder to track than public equity investing. After being in the newspaper for fixing horse races, and after making money in Victoria's Secret stock, that my ex flew down to Dallas and Mark Cuban loaned him money on the hard money market. And it's interesting, then look at what's happening at that time. So 1985, Robert Maxwell begins hiding his money. 1991, Robert Maxwell died. So between 1990, this is the difference between the underlying index and the forward price to earning multiple. And you can see just past 91, the price to earnings multiple just jumps up insanely. And so this is tech companies, you know, people would be like, well, that's Yahoo, that's Amazon. This is companies creating whole new ways of doing business in the world. And maybe that's right. I am definitely not an expert on this time, but it does certainly look to me visually like it got kind of juicy and glitchy around that time. And it does seem to me that a lot of money was exuberantly drawn into a lot of these tech companies prior to the boom. So I think it would be worth wondering if there was any market manipulation that might have benefited both the post IPO companies. Let's say a bad actor had invested in somebody like Mark Cuban before the IPO, and then helped to create an environment when that class of tech founders found themselves in this amazing period of exuberance. And somehow after the bubble, nobody is really left holding the bag except for dumb money like you and me. So then it's interesting also when you think about the advisors and the traders in the options market. And the authors in the piece that was critical at Kellogg of the options industry for increasing the risk premium, they also pointed out that there's something unnatural about a cycle where the people kind of creating the demand. So the options traders are the ones who are saying, "Ooh, there's so much demand for options." The people in the know that the fear index is going to go up. Smart guys know that. They're the ones saying that, right? But then who gets paid when people need to buy options? That would be options traders. So they get more options premiums, more insurance essentially. Oh, people got to buy that insurance because the guys in the know something is about to happen. But it also drives up valuations because it's creating volatility both ways. So it's driving up valuations on these tech stocks that might have been invested in by those same actors. So it's interesting. And when you think of the feedback loop between the advisors and options traders, because most individuals, I don't think, would be able to buy options. I think you'd have to go through a stockbroker or a financial advisor. So the person claiming to know what all the customers want is making money by the customers wanting options. And the person, because I also get money on the options trades, and the person creating the demand is getting money. It seems like everyone gets rich when American investors are terrified, except American investors. And that risk premium that goes into Fidelity going from in 1985 something like 40 billion to over $1 trillion in 2000. Wow, talk about some growth. They must have done such a good job, right? So because this entirely new variable annuity industry comes into being, this new fear, which, oh, sorry, yeah, we created the fear, but maybe a little more fear than you needed, but it's okay because we're rich. So that's interesting. A lot of people made money. And I would think that money that made the Johnson family, and I'm so happy they're so rich because it's a private company. They probably could have built businesses in their towns or sent their children to college. Those are other investments people can make with their money. I don't know. I just know there's something rotten in the state of Denmark. And I'm just hoping at some point somebody knows more than me and can tell me something helpful. And I'd like to not go to jail.